Good morning. This is Professor Menton, and sorry I can't be with you today. I'm going to go ahead and try to do Chapter 5 in a video format. Um, I have, they keep having these allergy or allergic attacks, and they're still pretty frequent. So if I have to stop for a moment and take care of that, then I will. Um, so, Chapter 5, we leave the sphere of service businesses and are now entering the sphere of manufacturers and excuse me, merchandisers, and then we will later on go to manufacturers. But anyway, so for right now, the difference that you need to be aware of is that merchandising businesses, which would be like a Walmart or an Amazon or Gap, American Eagle, any of those, have inventories that they have to track. And so inventories present problems that are unique in at least as it relates to um, service businesses, which don't actually carry inventories. Now, I know that some of you may say, well, businesses that actually blur the lines, and that's true. And they, even though the service businesses are few that would carry inventory, there's certainly, if you think about McDonald's, the inventory that they carry is their food inventories, and they keep track of those. So, are they a service business? Are they a merchandising business? Well, they're still a service business because at the end of the day, you're going there not for their inventory, but for the food that they prepare for you. So, it is still a service business, even though it may have some elements of merchandising inventory. Anyway, so what we want to do is we want to describe these activities that merchandisers have and maybe compute some acid test and gross margin ratios and things like that. Okay, so let's jump right into it. When we have a service organization, what they do is they sell time. They sell their time to prepare your food. They sell their time to do your laundry. They sell their time to prepare financial statements or wills or whatever the case may be. And so they have revenues and then they have expenses and then net income. And essentially, that's what we had when we did Media Moguls, although I did throw a little bit of a curveball in there for you when I had a cost of sales. So it's kind of like a precursor to this, which shows you what a merchandiser has. You have net sales minus the cost of goods sold, or the cost of sales as we did it in Media Moguls, equals gross profit. So these are reciprocals of one another. So if this is 55%, this is 45%, etc. And then we're going to subtract from there expenses, and then net income is the result of that. So I'm going to go to the slideshow, see if I can't make this slide a little bit bigger. Okay, so that's really what I wanted to do. Now, you can see when you look at the income statement, you have net sales, cost of goods sold, gross profit. And again, this minus this is equal to this. So obviously, this minus this is equal to this, right? And then you're going to subtract your expenses to come up with your net income. Okay, so how does this all work in terms of a cost flow? And this should be pretty clear. I mean, when we start our business, we typically don't start with inventory. We have some cash. And so we go down to the local supplier, or we do it online. We might order something from China or Vietnam or wherever, and then we're going to pay for it. When you order things from overseas, a lot of times letters of credit are involved, which we're not going to get into. But when you buy things from locally, that means in the United States, what you're going to have is an accounts payable set up. But you have to have some cash to start with because a lot of companies won't sell to you on credit until you've established some credit with your company. So let's assume for a moment that you're starting with cash. And what do you do with it? Well, in their particular uh, slide here, they're showing bicycles that you're going to buy. So what you're going to do is you're going to purchase these bicycles, which now go into your merchandise inventory. So when you buy it, it's going to look like if you do it for cash, let's say it's $10,000, you'll have merchandise inventory debit, which is an asset, and a credit to for $10,000 to cash, which is also an asset. Now you turn around and you sell these things on credit. Okay, and when you sell them, this is where it gets to be a little bit involved. So when you have a perpetual inventory, that is, you're keeping track of your inventory at all times. And if you had these kind of expensive bicycles here, you would have a serial number on each one of these things or something on it to identify which one it is, especially if you're in this $1,000 plus category. Um, but when you sell one of them, what you're going to do is you're going to debit accounts receivable. You're going to credit the sale, whatever that credit sale amount is. But you're also going to do something else. You have to take it out of your merchandise inventory. So you're going to debit the cost of that particular bicycle in this case and credit the merchandise inventory so that it goes out of your merchandise inventory. Otherwise, you overstate the asset. Now, this is an ongoing thing, so you'll want to do that in actually perpetual inventories. And we'll talk a good bit about those. But for the most part, that happens automatically. But you'll see in a few moments how that works. Okay, so we have that credit sale. We have two entries going on. We relieve the inventory because it's no longer there, and we charge the cost to a cost of sales or cost of goods sold account. The accounts receivable that we set up, that is, we debited accounts receivable, credited sales, we're actually going to collect that. We hope we're going to collect that cash, and then we start the process all over again. So that's how it works. That's the cycle of merchandising from a merchandiser's perspective. Okay, now inventory systems. Here's a way that an inventory system actually works. You have a beginning inventory, we assume, unless you're starting the business from scratch. Then you're going to have some net purchases. When it says net purchases, what that means is gross purchases minus any returns, minus any allowances, minus any discounts that you receive, plus any freight that you have to pay. So again, it's gross purchases minus discounts, returns, and allowances plus freight. Any freight in that you have to pay. And we're going to get into the discussion of freight here in a few minutes too. Those two things equal merchandise available for sale. And I always talk to the students and say, well, you just think about it. If you go to your cabinet, you look inside the cabinet, say you love chicken noodle soup or ramen noodles, and you look in there and you've got two little containers of ramen noodles, and you say, man, I got to go get some more. Well, that's your beginning inventory. If you go down and you buy eight more, then you have, in this case, noodles available to eat of 10. So that's how you get there. Now, from that, you're going to subtract your ending inventory to get your cost of goods sold. Or you can subtract your cost of goods sold to get your ending inventory. And again, we'll deal in that or get into that a little bit more. Now, there are a couple of different inventory systems, and by far and away, I think the predominant one in the United States today are perpetual systems. And so, what a perpetual system means is that every time that you get something into your organization, you're going to scan it and put it in the inventory. And every time something goes out, it'll automatically come out. Now, we're showing you how the sausage is made. All right. If you go to McDonald's, let me go back, not to McDonald's, but to Walmart. If you go to Walmart and you go back and you pick up, say, a can of beans or a package of hamburger meat or whatever, And now you go to the front and you scan it and put it in your bag. What you see, what you see is the price of that hamburger meat or the price of that can of beans, whatever it is, pops up, and then you have a bill to pay for whatever that amount is. That's the selling price. Behind the scenes, what's happening is the system, the minute you ring it up in the front, it takes it out in the back office. In other words, it takes it out of the merchandise inventory and it charges the cost of goods sold. You just don't see that part. Uh, but the but the beauty of a system that is perpetual is I should be able to tell at any point in time, and this of course is theoretical, but I should be able to tell at any point in time how many cans of beans I have total. And those will be either on the shelf or they'll be back in the warehousing department or whatever. But well, we should be able to see at any point in time exactly how many we have on hand. And for that reason, if you go to the shelf and it's empty, and you run down one of these employees, you'd say, "Hey, you don't have any of these on the shelf. Do you actually have some?" And they'll look up in on their device, they'll look up to see what the inventory on hand is. And if they still have some, they'll say, well, yes, we have some. If they're not on the shelf, they're probably back in the warehouse. And if you want it, you ask them to go back and retrieve it for you. Periodic systems over here work a little bit differently. What happens with them is that you don't have merchandise inventory when you buy it. You have a thing called a purchase. Um, you're only going to um, adjust the periodic system for inventory at the end of the accounting period. Now, I will tell you that uh, that's really not true for most companies. What we do, we have a standard costing system, and the standard costing system takes it out of the standard costing system every month based upon your bill of materials and so forth. So it's rather involved and rather difficult to understand. You could make a career out of periodic inventory systems. So we won't get into those that much, other than just passing. If I ask you, well, what's the difference between the two, then you know that the perpetual is updated all the time, every day, uh, as a sale or as a purchase occurs, where the periodic system is not. Okay, now we're going to deal here with perpetuals again, because by far and away, those are becoming the predominant way to track your inventory. And I mean, it's even true in small places like convenience stores and mom and pop shops and so forth. You'll see that when you go through, they have a little scanner, and the scanner hits the barcode and knows that it's worth, you know, $3.17 on the sales side and $1.22 on the cost side. Okay, so here we have purchases without cash discounts, because we have to consider what happens when we have a cash discount. On November the 2nd, Zmart purchased $500 worth of merchandise. So there's your entry. Merchandise inventory 500 and cash 500. Now, this is assuming no cash discount. And and more probably we we've seen companies go to no cash discount um, because the interest rates have been so low that maybe they didn't want to have these. Maybe they didn't want to do any discounting. Um, and we could get into the reasons why, but basically, if you do discounting at 2%, and that's what we're going to do right here. If you do discounting at 2%, that happens within 10 days. So the interest rates are extraordinary if you think about it. I'm going to make 2% in 10 days. Well, right now, the uh, right now the prime rate is probably hovering around 3% or so, and that's for a year. That's for a year. You're going to get 2% if you pay within 10 days. So you start extrapolating that out, and there's a formula for it that you would see when you get to finance. If you get to the finance classes, you will see those formulas on how that gets determined. Anyway, it's not exactly as it's not exactly what you would think because you have to consider this other 20 days here. But anyway, um, so this is now with a cash discount. So on November the 2nd, Zmart purchased $500 worth of merchandise inventory and account credit terms, 2% if you pay within 10 days. You must remit the net within 30. That's what this 2/10, comma N/30 means. You get a 2% discount. In other words, on this $500, what's 2% of 500? Well, it's $10. You get a $10 discount if you pay within 10 days. Otherwise, you have to remit the entire 500 in 30 days. And this is just going to show you what I just told you. Okay, why do we want to do it? Well, we give credit terms because we're trying to induce companies to pay their bills early. Remember that I've always told you, um, and I'll say it again, cash is king. If you can get your cash in faster, then you're going to be in better shape because you have ability to pay your customers, excuse me, your vendors. You have the ability to pay any of your bills, to buy new inventory, to have capital additions, and all sorts of things. If you have cash, if you don't, those things become a lot more difficult. Um, so we want to get our money in early, but you have to be careful about how much the discount you're giving. Here's what an invoice looks like, and they have all of this stuff here. We have sold to, these are the people who are buying it. And notice that they have some degree of detail here. Tom Novak, purchasing agent, attention to him. Now, in your file, if you want to think about this kind of more holistically, in your file for Tom Novak, you probably know, is Tom married? I mean, does he have children? Do you know what their birth dates are? Um, those kind of things, so that when Tom's birthday comes up, your computer tells you, hey, you need to send Tom a happy birthday notification. Same thing might be true for his children. You may not know the exact dates, but uh, if you do, if you know that the month is October that they're born or whatever, then you can always send a happy birthday notice out early in October, and phrase it like, I understand you're having a birthday this month, so happy birthday, blah blah blah. Okay, you're going to have an invoice date and an invoice number. Okay, this is what you will refer to if there's an issue that you need to deal with. This invoice number is going to be a unique number so that they can look it up by invoice number on their computer typically. They probably also can look it up by name, in this case Trex, but if you have this invoice number, it saves a lot of time because they may be buying, 10, 15, 20, 25, I don't know, could be 100 times a month from you. So if they're going to usually ask for the invoice number because it's easier to find that way. Here's your purchase order date, and your salesperson again is number 141. The terms 2%, 10, net 30, and FOB destination. That means that it's free on board. That's what FOB stands for, free on board to the destination. And so if it's free on board to the destination, here are some really critical issues for you. Okay. FOB destination means that I'm going to send it to your plant free of freight charges. In other words, I'm picking up the freight if I'm the seller. But there's another thing that's probably just as important, and that is I have the risk of loss between my plant and your plant. It's also in my inventory until you receive it. So those are the critical issues. If I have the risk of loss, if something goes wrong with that shipment, I'm the one who has to follow it up. Um, And so I would have to contact FedEx and say, "Where's the shipment?" Or I'd have to contact FedEx and say, "We had some damage in transit." But that would be my issue. So when you can get FOB destination, you want it, okay? Because it saves you on freight costs, and it also puts the risk of loss on them, and it keeps it in their inventory until you actually receive it. Now, this is only really critical at the end of a period, that is, at the end of the year. When the end of the year rolls around, you have to figure out what your cutoff point was. So if you cut off at the 27th of December, then you have to figure out at the end of um, after December the 27th, anything that was in transit, does it belong to you? In which case it goes in your inventory and it was FOB shipping point, or does it belong to the seller? At which point it belongs to them, and I don't have to consider it as part of my inventory at the end of the year. And then, of course, you have whatever these things were that you were um, actually buying, okay, buying or selling, depending on your point of view. Um, Here's when we pay within the discount period. Now, notice that they have to relieve the entire 500 of accounts payable because otherwise it would look like they still owed money. They're going to credit the merchandise inventory, the asset merchandise inventory, because they really didn't pay $500 for it. They only paid 490. So you want to look at this slide very carefully and see what happens here. And you may have to go back to the first one to know that there was um, a merchandise inventory debit and an accounts payable credit. Okay, this is we're buying something and we put it in our merchandise inventory, but now we have to take out a component of this. I'm going to stop right here for a second and kind of talk about the idea of um, net. That is, buy it, when you buy it, if your policy is to take all discounts, then what you could do is record it simply at 490 here and accounts payable at 490. And then if you didn't pay it within the discount period, you'd have to have an account called discounts lost, which would not be good for whoever didn't pay it on time. So here you see how this all works. And I mean, you can look at these slides on your own. I don't really need to go through them. And we're trying to get through this thing within some sort of a reasonable time frame. Okay. On December the 2nd, Zmart paid the amount due in the purchase November the 2nd. And so notice that this date and this date, there are 30 days in between. Okay. And so therefore they paid it on the net date and they were not entitled to the discount, in which case they have to pay the entire 500. So now we have a return and an allowance that I referred to earlier as part of the net, how you arrive at the net purchase computation. And what is a return? Well, we return that thing to the purchase to the supplier. So if it's Walmart, I take it back to Walmart. Okay. If I bought it from Amazon, then I send it back to somebody that they designate at Amazon or one of their actual suppliers. Okay. A purchase allowance is I agree to keep it, but you're going to have to give me a discount. And I always think about one of the real um, one of the real ways to save yourself some money is if you go to a scratch and dent sale. So you go into an appliance dealer, and there's a dent on the side of your stove, and on the side of a stove, I should say. And so you go to the seller, you go to the clerk, and say, "Hey, look," or the manager, and say, "Listen, I'll take that, but it's got a dent on the side of it. So you're going to have to give me a discount." Now, you're not going to see the dent. You're going to push that stove into its slot and probably never will see it. Um, and so if you're not planning on selling the home or whatever in the next few months or so, and include the stove, then you know you're not planning on doing that, then it would be a pretty good thing to get a 10% price reduction just for a small dent. No one's ever going to see, but if it's noticeable, it might be something different. But even then, you can say, "I'll take it, but you're going to have to give me a discount or an allowance." Is the more proper term here. On November the 5th, Zmart issues a $30 debit memo for an allowance from Trex for defective merchandise. And so that is what it looks like. You're going to reduce the accounts payable for the allowance, and you're going to reduce the merchandise inventory for the allowance because you're not going to pay full price. You're going to pay something less. Zmart purchased $250 of merchandise on June the 1st with terms of 210 net 30. Now, this is where it gets really complicated. On June the 3rd, Zmart returns $50 of goods before paying the invoice. When Zmart pays the June 11 invoice, it takes a 2% discount only on the $200 of remaining balance. You can't take it on the 250 because you returned $50 worth. So here's the entire sequence of events. You have merchandise inventory, debit, the asset, the liability, accounts payable, credit. You indicate here that the purchase terms were 210 net 30. Now, you return $50. So you're going to debit the accounts payable to reduce the liability. You don't owe that much. In other words, you don't owe 250 now. You only owe 200. So I'm going to reduce it by a debit to the accounts payable and a credit to the merchandise inventory. Again, it's not in your inventory anymore. You have to credit it to get rid of it. It went back to the supplier. And so finally now you get to take your 2% 10 net 30. And in this case, you had a $200 accounts payable, which you're going to have to relieve the entire amount. And you're going to reduce again your merchandise inventory by $4 because you're only going to pay $196 for it. So you want to study these screens pretty carefully because these screens will indicate to you um, things that you're going to see on your examination. All right. This is what I talked about before. Who pays the transportation cost? If it's shipping point, the buyer pays it. If it's destination, the seller. So you'd obviously always want to be FOB destination if you could be. Now, one of the things that we also do sometimes is we prepay the freight, and we pay we go ahead and pay the freight up front, yeah, even though it's so that's FOB shipping point, but we then ask the supplier to handle any risk of loss while it's in transit. Um, Zmart purchased merchandise on terms of FOB shipping point, transportation charge is 75. And so when you actually get that $75 transportation charge, it'll be debited to merchandise inventory and credited to cash because the buildup of the inventory cost would be whatever that original cost of the item was, plus any freight associated with it. If you think about it, it makes perfect sense. If you go to Amazon and you buy an item for $10 and it costs you $3 in shipping and handling of freight, then the cost wasn't $10, it was 13. Okay, and this just shows you the net cost of purchases. Notice they're taking away the discounts, they're taking away the returns and allowances, and they're adding the cost of transportation or freight in. Okay, accounting for merchandise sales. You have net sales, and again, you start with gross sales, minus any returns, minus any discounts, and less any allowances to get to net sales. It shows up first as gross sales. So you have to subtract this, and this from it to get to this. Cost of goods sold is subtracted. Gross profit then is the difference between the two. And so if I gave you this number and this number, it's easy to make this number come out. Just subtract one from the other. Okay. I'm going to jump forward just a little bit because I've already talked a little bit about these. Um, but this shows you the actual transaction going on. Zmart sold $1,000 of merchandise. Merchandise had a cost basis of 300. Okay, so they went up. They bought $300 worth of stuff that they marked up and sent out their door at $1,000. Debit accounts receivable 1,000. Credit sales 1,000. Now that's the first part of the entry. On the cost side, cost of goods sold 300. Merchandise inventory 300. You have to do this because this merchandise is no longer there. And the other side of the entry has to be the cost for it. Sales discounts, it's just the opposite of what we were talking about before. Um, Sales discounts on credit sales can benefit the seller by decreasing the delay. Okay. In other words, you're getting your cash in faster. All right. Zmart completes $1,000 credit sales with terms of 210 net 45. And so you don't have to have net 30. Net 30 is industry standard when you have a discount. You wouldn't expect to see a 2% discount today. It might be a quarter of a percent or half a percent, something less than that. But it's still something you might want to take. Um, it just depends. You've got to be able to work through that formula to see what it benefits you to do it. In some cases, well, let me put it to you like this: if I had a situation today where somebody was giving me 2% 10 net 30, if they were doing that, then it would behoove me, it would make sense to me for me to go down to the bank and borrow the money on a short term note, say 9%, to pay that off. I still make money. I still make money. And I'll try to, within the next few days or so, I'll try to throw out or bring up in class or post it to your announcement page what the impact of that really is so that you can see it. Okay, so here we have Zmart completing $1,000 sale to 210 net 45. Accounts receivable, same thing. Cost of goods sold, merchandise inventory, same thing. Buyer pays within the discount period. So you're going to get the cash. This is the other side of it. You remember that we had on the other side, we had a debit to accounts payable and a credit to merchandise inventory and a credit to cash. This is the other side. Okay, this is um, the seller side. Okay, now they get the cash in. They're the ones that get the cash. They've issued a $20 sales discount. They have to get rid of the entire accounts receivable. Remember that accounts receivable and accounts payable, they're just mirror images of one another. If I sell something to you, then I have an accounts receivable. You have an accounts payable. If the situation is reversed, I have an account payable, you have an account receivable. And so whatever happens within that transaction, like in this case, the $20, um, will be reflected on both sets of books, right? On their set of books, what you're going to see is a debit to accounts payable for 1,000. You're going to see a credit to merchandise inventory of 20 and a credit to cash of 980. So it's just a mirror image. If you don't pay it, of course, within the discount period, you got to pay the net. Okay. Sales returns and allowances are just exactly the same thing, except like in the mirror, what you had before. If I have a return, I return it to the seller. Okay. This is the other side. This is what the seller has to do. Okay. Sales returns and allowances. They're going to put this in a special account so that they can take it against the gross sale. And then cash credit of $15. So customer returns merchandise which cost 15, or which sold for 15 cost 9. And now you have to come down here. These are not defectives. That means they're going to go back on the shelf. They're going back on the shelf. I'm just going to put it back in merchandise inventory, take it out of cost of goods sold. It's like the sale never happened. If they are defective, then we have to figure out how much can I put back on the shelf, in this case, $2. How much was defective? $7. And the cost of goods sold is 9. I don't know that we have anything like that on the examination, but it's good to know that when somebody brings some things back, some may go back on the shelf because they're still okay products, and some may not. Okay, and this is the other side of the allowance side. Sales, returns, and allowances in cash, $10. Assume that $40 of the merchandise Zmart sold is defective, but the buyer decides to keep it because Zmart offers a $10 price reduction. And you can think of it on your own personal stuff. If you went down to Walmart and you bought a shirt, and let's just say that there's something about the shirt that's not quite right, you take it back to Walmart and say, "Look, I'll keep it, but I'm not paying full price for this. It's got a flaw." And so the manager says, maybe, "Okay, I'll tell you what, I'll give you $2 off or $3 or whatever the case may be." And that's what's happening there. Okay, I think that I'm going to call it. Oh no, I've got to do this one. Here are the closing entries for a merchandiser. Okay, we always close what? Revenue first. In this case, that's sales. That's what our revenue stream is, sales. They had $321,000 worth of sales, net sales. Okay. Um, Excuse me. I think that's probably in this case. Um, Let me go back up here and check and see because you can do it a couple of different ways, but um, I want to just check and see. That's the invoice cost. Well, where's the? Let's see here. Well, they got different numbers, so you can't track it back precisely here. Maybe. Yeah, just bear with me for a second. I'm trying to see where they're going with that. This could be the gross sale. Okay, this could be in probably. I guess it would be the gross sale in this case. So you're going to debit sales for 321,000. You're going to credit the income summary. Same thing you did before, except you had some sort of service revenue. It might have been consulting revenue or whatever the case may be. Now we want to close the debit balance temporary accounts, and those would be all your expenses. And notice what happens here with your discounts, returns, allowances. These are these are debit balances because they reduce your sale value. Okay, so if they're sitting out there, you have to credit them. And the way that this normally will work is you will do all of your credits first. Typically, you do all your debits first, but you don't know what this number is until you do all your credits. The only ones that they've added here are the discounts, the allowances, and the cost of goods sold. Everything else is still the same. Rent expense, we're still going to close. Insurance expense, supplies expense, and so forth. So that takes care. So now you have 321 and 308. The difference between these two numbers is your net income. In this case, income summary and capital. So in other words, you had net income here be, before withdrawals. You have net income of $12,900 going into the capital account. Now they pulled, whoops, somewhere here, they just barely touched it. They pulled out $4,000 for their own salaries or whatever the case may be. So you have to debit that 4,000 and credit the withdrawals. So what we know is that therefore that to the balance sheet, going to the balance sheet as the new capital number or an addition to retained earnings is this number minus this number or $8,900. Okay, you've seen a lot of income statements, you've seen a lot of balance sheets already in uh, media moguls. I don't want to go over those again. You should be very familiar with what's on them and so forth now at this point. Okay, so I'm going to call it quits for this video. Again, the longer I go, the more lengthy time it takes and the more overhead it produces. So that's going to be it for now. This item or this group of items will be on your midterm. So make sure you watch the video. Thank you, and I'll see you later.